RGC Resources, ticker RGCO, just reported Q3 2026 earnings, and we have a consensus miss across the board. EPS came in at 5 cents.
Missing the 6-cent consensus by a penny.
Right, exactly. And revenue was $17.11 million, missing the $18.19 million expectation by, well, over $1 million.
Management immediately narrowed their full-year fiscal 2026 EPS guidance to a range of $1.29 to $1.32.
Okay.
And given that their 9-month year-to-date EPS is already sitting at $1.37, that updated guidance explicitly prices in a standard seasonal loss for the fourth quarter.
Yeah, and the stock reaction was, it was a bit choppy at first. Shares initially dropped in after hours, trading to $21.44.
That's down over 4% from the previous open.
Right. But by the time the earnings call actually kicked off, the stock had stabilized, ticking up about 1.1% to $21.94.
So the market essentially just shrugged off the headline miss as, a routine seasonal dip for a regulated microcap utility.
Yeah, but a penny miss on EPS isn't really the story for you today. We are looking at a microcap utility that is secretly fighting this multi-front war against sticky inflation, a catastrophic failure of a massive legacy gas tank, and a shrinking customer base.
It's a lot to unpack.
It really is. Today, we're figuring out if their 3.9% dividend yield is a safe harbor or a yield trap for your portfolio. We have to look under the hood at the segment performance and the margins driving this quarter.
Yeah, because the income statement shows a classic margin squeeze basically in progress right now. Q3 net income was virtually flat year over year. So $559,000 this quarter versus $538,000 last year.
Which doesn't sound terrible on the surface.
No, but the anomaly here is that their operating margins actually went up by $757,000.
Really?
Yeah, that boost was heavily aided by higher non-gas base rates that actually took effect back on January 1st.
So a $750,000 margin increase should theoretically flow straight to the bottom line.
You would think so. Yet operating earnings nominally declined to $1.17 million.
Wow. So they generated more margin, but operating income shrank.
Exactly. That extra $757,000 basically vanished into operating expenses. Management blamed sticky inflation.
And just to clarify, they weren't talking about the cost of natural gas, right?
Right, because utilities just pass that through to the customer anyway. This was persistent inflation hitting their core operations. So personnel costs, professional services, IT support, the day-to-day cost of just keeping the lights on swallowed that entire rate increase.
The volume metrics make that margin squeeze even more apparent, I think. Firm delivered volumes.
Which represents the core residential and commercial heating customer.
Right, those volumes were completely flat. At the same time, interruptible volumes to industrial customers increased. And, on paper, selling more gas sounds like the logical solution to rising expenses.
Except it just doesn't work that way because of how those specific contracts are structured. We should probably define what interruptible actually means for you if you're holding this stock.
Yeah, good idea.
So industrial clients get a significant discount on their gas rates in exchange for a massive caveat. The utility has the right to completely shut off their gas supply during peak winter demand just to ensure their residential homes stay warm.
So RGCO is moving more volume through the pipes to those factories.
Right, but the profit margin on every unit of that interruptible gas is severely compressed compared to what they make, heating a residential home.
Yeah, so it inflates the volume numbers, but it doesn't generate the high margin cash flow needed to outpace that sticky personnel and IT inflation.
Exactly. And that dynamic really exposes the fundamental flaw in how regulated utilities operate in an inflationary environment. They're basically trapped in a reactive cycle.
It's like a regulatory treadmill. Think about the time lag mechanic here. They suffer the financial damage of inflation today, right? They pay the higher IT costs and the higher wages today. Then they have to spend months pleading with the regulators for a rate hike just to cover those costs.
And by the time they actually secure the higher rate, like the one they got on January 1st, inflation has already moved the goalposts again.
Exactly. They're running as fast as they can just to stay in the exact same place, and the operating income actually takes a step backward. Which brings up a massive red flag for anyone looking at this stock's dividend. Simply, Walden flagged a 243% cash payout ratio for RGC Resources.
Ouch. That metric is critical because it strips away all the accounting noise. Like a standard dividend payout ratio compares the dividend to net income.
Right, but net income includes non-cash items, like depreciation.
Exactly. The cash payout ratio compares the dividend to the actual free cash flow the business generated from its operations minus whatever it spent on capital expenditures. A ratio of 243% means they are paying out, well, more than double the cash they are actually generating.
So they're bleeding cash to fund an 87-cent annual dividend. If their operating margins are being eaten alive by inflation, that 3.9% yield starts to look, honestly, incredibly vulnerable.
Well, the answer to that dividend sustainability question really lies in their regulatory pipeline. RGC Resources just secured a major regulatory lifeline via a rate case settlement with the state commission.
Okay, what are the details on that?
So starting August 1st, they are implementing $3.85 million in incremental annual non-gas-based revenues.
Which is slightly below the $4.3 million they originally requested, I think.
Right, but it's still a substantial injection of top-line high-margin revenue. That settlement is basically the primary mechanism they are relying on to bring that cash payout ratio back into a sustainable orbit.
But there is a near-term cash drag hidden in that settlement, right? They secured the $3.85 million, but they also have to accrue $275,000 for customer refunds.
Yeah, that's the catch. Because the regulatory process is notoriously slow, utilities are often allowed to charge interim rates while the case is actually being decided.
And RGC implemented interim rates earlier in the year.
Exactly. So now that the final settlement came in lower than what they were charging on an interim basis, they are legally obligated to refund the difference to the ratepayers.
Okay, so the permanent rate structure is now locked in, but we really have to ask if that new rate structure is actually going to drive growth or if it's just acting as a patch.
Honestly, when you dig into management's commentary, it looks much more like a patch. They disclosed a major operational headwind, the total loss of a top 5 industrial customer that completely ceased operations in March.
Oh, wow. Losing a top 5 customer for a microcap utility, that's a structural blow to system demand. We really have to look at the fixed cost dilemma this creates.
Oh, absolutely.
The underground pipes, the maintenance, the safety inspections, I mean, those costs are entirely fixed. They cost the exact same amount to maintain whether 100,000 units of gas are flowing through them or 10 units.
Right.
So when a giant industrial customer shuts its doors, those massive infrastructure costs don't just disappear. They get reallocated. The utility eventually has to spread those fixed costs across the remaining residential customers.
Which naturally drives up residential heating bills. And when residential bills spike, regulators face intense political pressure to deny future rate hikes.
Yeah.
If we contextualize the loss of that industrial client, we have to look at the broader demand picture. Year to date, their residential and commercial volumes are already down 1%.
So you have a shrinking core base, plus a gaping hole from a top 5 industrial giant shutting down.
Exactly. That new $3.85 million rate hike isn't funding aggressive dividend growth or massive pipeline expansion. It is actively plugging the revenue hole left by that departing industrial client, literally just to keep the ship steady.
So the regulators gave them more money per unit of gas, but they have fewer units of gas flowing through the system to their most reliable customers. The pressure is completely on the infrastructure they do have to perform flawlessly.
But that's where the physical and financial risks looming over the company become severe. Tucked into the notes is a catastrophic issue with their LNG tank.
Yeah, this is crazy. They have a 54-year-old, 200,000-gallon LNG peak shaving tank, and during an inspection, they found structural damage.
The operational impact of that damage alters their entire winter strategy. A peak shaving facility is the ultimate safety net for a gas utility.
How so?
Well, on the absolute coldest days of the year, when everyone turns on their heat and external pipeline capacity is entirely maxed out, the utility vaporizes that stored liquid natural gas to meet the peak demand. They literally shave the peak off the demand curve.
Oh, I see.
Yeah, and management confirmed this facility will be entirely offline for the upcoming 2026-2027 winter season.
I saw the workaround they were planning, and it sounds incredibly expensive. To keep the heat on for their customers without their own storage, they're being forced to rely on trucking in LNG from external sources and purchasing extra premium-priced pipeline capacity on the spot market.
It's not going to be cheap.
Not at all. Financially, they've already recorded a $2.09 million regulatory asset related to this damage.
And, a regulatory asset is essentially an IOU from future ratepayers. They are spending the money now to deal with the tank, but they are allowed to put it on the balance sheet as an asset because they expect the regulators will let them charge customers for it in future rate cases.
Okay, but the major risk here is that the final bill for that IOU is completely unknown, right? Total remediation costs, whether they have to repair this 54-year-old tank or just demolish and replace it entirely, are undetermined.
Yeah, it is also unknown how much, if anything, their insurance policies will actually cover. They are aiming for a 2027-2028 restoration, meaning they have to navigate at least one full winter completely exposed to external supply constraints.
And while they are facing unknown costs to fix their physical infrastructure, they are facing a massive immediate spike in the cost of their financial infrastructure.
Mhm.
Let's look at the balance sheet. RGCO had a $15 million delayed draw note maturing right now in August.
And they are negotiating a refinancing deal for it. We should probably define the mechanics of a delayed draw note for you.
Yeah, go ahead.
It functions a bit like a giant corporate credit line. The borrower doesn't take the entire $15 million up front. They draw down portions of it over time as they need capital for specific projects.
Right.
The catch with this impending refinancing is the interest rate environment. They're swapping out a historical fixed interest rate of roughly 2% for current market rates, which are tied to SOFR, the Secured Overnight Financing Rate.
Moving from a 2% fixed rate to a floating SOR rate is going to significantly spike their borrowing costs at the exact moment their operating margins are already under pressure from inflation. I mean, you have the O&M inflation, the lost industrial revenue, the broken LNG facility, and now a massive step up in debt servicing costs.
Yeah.
Yet, despite all these cascading financial pressures, management reaffirmed their $22 million capital expenditure plan for 2026.
Yeah.
They're actually pulling forward some projects, specifically the Mountain Valley Lafayette main extension, into this fiscal year.
Funding a $22 million CapEx program when operating cash flow is being squeezed and debt is suddenly much more expensive presents a really serious structural problem. They cannot simply take on massive amounts of new debt to fund these projects without risking a breach of their debt covenants.
Because creditors enforce strict debt-to-equity ratios.
Exactly. If a utility breaches those covenants, they default on their loans.
So to fund these critical infrastructure projects without blowing up those covenants, the company has engaged in continuous dilutive share issuances. Throughout the fiscal year, they've been quietly issuing shares through various stock plans.
Yeah. Their total outstanding share count now exceeds 10.4 million shares.
And every new share issued means the existing equity pie is sliced a little thinner. It dilutes the earnings power of the shares you might hold in your portfolio. They are funding their hard asset growth by selling off pieces of the company's equity, slowly diluting the retail investor.
If their core distribution business is bleeding cash to inflation and their debt is getting more expensive while they dilute the stock, you really have to look for a cash cow somewhere on the balance sheet to offset this.
Right.
The one structural offset actually pulling its weight is their equity earnings in the Mountain Valley Pipeline, or MVP. This unconsolidated affiliate brought in $764,178 in equity earnings just for this quarter alone.
So, while the core regulated distribution business fights inflation and infrastructure decay, their midstream investment is generating meaningful high-margin cash.
Yes.
And it is not just a static asset either. Projects related to MVP, specifically the Southgate Extension and the Boost Compressor projects, are progressing. As those come online and expand the capacity and reach of the MVP system, RGC Resources' share of those equity earnings should theoretically increase, providing a non-regulated revenue stream to really help support that overall dividend.
Let's recap the setup for your portfolio. RGCO is a microcap utility trading at a PE around 16x.
Okay.
Wall Street's currently flags it as an undervalued gas stock based on their internal metrics. It offers a solid 3.9% dividend yield and the theoretical stability of a regulated monopoly.
Right.
But it is fighting a multi-front battle. It is battling sticky inflation and its operating costs. It has to absorb the lost demand from a major industrial customer shutting down, and it is dealing with severe infrastructure decay with its primary LNG peak shaving facility out of commission.
Which forces you to look beyond the surface-level stability of a utility stock and ask a critical question. With their legacy LNG peak shading facility out of commission and their borrowing costs rising dramatically as old debt matures, is RGCO's traditional distribution model becoming dangerously over-reliant on external pipeline capacity like the Mountain Valley Pipeline and constant regulatory rate hikes just to maintain its dividend?
Yeah, what happens to this stock and that yield if the regulators eventually look at the shrinking customer base and just say no to the next rate increase?
Follow the show for daily earnings coverage.